Thank you for joining me this evening. So, I'm your host, Frederick Middlebrooks, and this is Real Estate Economics for Investors. So, we are going to be diving into a lot of different stuff when it comes to investment properties and buying investment real estate. So if you're looking to be a real estate investor, this is going to be really good information for you because it's going to give you a lot of tools and information that will help you get a kickstart on some of the things that you need to know in order to be able to invest in real estate, and some just good stuff to know in terms of the economic return of being a real estate investor. Now, if you're already a real estate investor, some of this might be things that you may know, but some of it will also be good information for you to get that you might not be aware of, particularly with some of the loans that I'm going to talk about, as well as some of the numbers that we'll see in slides to come as well. So I don't like to delay things much. We're going to go jump straight on into the presentation. So real estate economics for investors, why you want to invest in real estate. That is not a question. That is a statement. And why you want to invest in real estate are for a few reasons. One is the cash flow. So there is a cash flow aspect to real estate that we'll talk about. Next is the appreciation, and then stability. These are the three things that we're going to be discussing mainly throughout the presentation for the remaining slides that we have to go through. So getting on into it, one with the cash flow. Oh, before I get there, I do want to say debt service coverage ratio loans are a game changer. If you're not familiar with what a DSCR loan is, this is a loan product which opens up real estate investment to so many more people, because what it does is it allows anyone to purchase an investment property regardless of how much money you make. So previous to the DSCR loan, you had to have 20% down payment, and you had to make enough money to be able to pay for wherever you were currently living, as well as the investment property that you were looking to purchase. However, with a DSCR loan, the way that these loans work is that we don't even look at your income. And when I say we, I mean mortgage loan officers, which is what I am as well. I am a mortgage loan officer. And so we do not look at your income when we are looking at a DSCR loan for an investment property. The entire approval is based on your credit score, you having enough money to cover the down payment, which is at least 15 to 20%. And if the property will rent for enough to cover the mortgage. But check this, even if the property doesn't rent for enough to cover the mortgage, you can still get a DSCR loan. You can still get a loan and purchase that investment property, because there are DSCR loans which will go all the way down to no ratio, meaning that regardless of what the property rents for, you can still purchase a property or get a loan to purchase an investment property without even having a job or making any income, as long as you have, again, the down payment and a high enough credit score. So again, DSCR loans, or debt service coverage ratio loans, are a game changer when it comes to purchasing investment property, because this really opens the door for a lot of people to be able to own investment property regardless of what their income is. So I want to state that up front before we get into the rest of the presentation. So let's jump into cash flow. Cash flow I put here as the long game, but it is worth the wait. The reason I put the long game is because when it comes to cash flow, a lot of times when you purchase a home, particularly at the onset, you're not going to be cash flowing immediately. And what I mean by that is you're not going to be renting it out for more than enough to cover the mortgage and have excess money left over. So let's say, for example, if you purchase an investment property and your mortgage on that property is $2,500 a month, odds are you're not going to be renting it immediately for more than $2,500. You might be renting it for a bit less than that. And that's because typically rent for a property is typically a little bit less than what it is to purchase that for a mortgage for that same property at the onset. And we'll get a little bit into the graduation of those rental payments versus the stability of those mortgage payments over the years, because I got a slide that really does show that pretty well. This slide right here. So buying versus renting. If you checked out my last webinar last month, I talked about real estate economics for renters. I had this slide in there, and I brought this slide back for this presentation because this slide really does paint a good picture to let you see how rent payments over time increase Whereas that mortgage payment, the principal and interest, stays the same. Again, your principal and interest when you own a home is locked in for that 30 years. However, your rent is increasing year over year over year at an average rate between 2 to 5%, depending upon where you live, because some cities, some counties have a higher appreciation rate for rent or a higher increase rate than rent than some other counties do. But as you can see here in year one for a $350,000 home, that home and might have a mortgage payment of really it's around $2,600. The reason it says 29 here is because I wanted to give the full picture of all of the costs involved with owning that home. So one of the costs involved with owning a home is maintenance and upkeep. And on average, maintenance and upkeep is about 1% of the purchase price of your home every single year. That's what on average homeowners spend in maintenance and upkeep of their homes, about 1% of the purchase price of their home on any given year. So with that, I added in an extra $300, which comes up to just over 1% for our $350,000 home here. So that's why you see $2,900 for the mortgage payment, which is in the dark blue. Really, the mortgage was about 26, but I wanted to also account for that maintenance and upkeep as well, so that you have that true picture of all the costs involved with owning that home. In the purple, we've got what you would pay for renting the similar property for this $350,000 home. So as you can see at the beginning in years 1, 2, 3, you're paying less in rent than what you are in a mortgage. But that mortgage payment, again, the principal and interest is staying the same. So as we go on from year to year to year, rent is going up at a rate between 2 to 5%, but that mortgage payment is staying the same until we get to year 7, where now we're about even. And after that, that's when we're cash flowing this property. Now, for this example, we're cash flowing this property around year 8. Cash flowing meaning that we are making more than what it's costing us in a mortgage payment and maintenance and upkeep and everything. So for this example, it's about year 8. However, you can purchase a property that's cash flowing after year 3, year 4, year 2. It's possible to purchase a property that's actively cash flowing when you purchase it. Those are a little bit more hard to find, but there are a few of those deals out there as well. But that's something that you definitely want to at least have in your mind is when you're getting into investment property, we're in this thing for the long game, not the short game. So I'm not getting much into the fix and flip of investments, but talking more of the buy and hold for rental purposes when it comes to investing. So moving on, want to keep in mind, again, that 2.5% that we talked about earlier with the rental increase going up. So that's something that you have working in your favor. Also, you have your renters that are paying your mortgage. So when you have that mortgage payment, having your renters be able to cover that, or at least cover most of it in those earlier years for you, is something that's really going to help you be able to build that wealth down the line. And speaking of building wealth, that last bullet point, your home is appreciating the entire time. And that's going to take us into our next point, which is appreciation. So when we talk about appreciation, this is the gradual increase of the value of your home over time. Your home, you might purchase it in 1 year for $300,000. 5 years later, that home might be worth $340,000. That's appreciation, that gradual increase in the value of your home over time. And so historically, appreciation outpaces inflation. So inflation is something that is just a part of our economy. And with that, you might have currently, I think the last time I checked, inflation rates were around 3.4%, 3.1% inflation rates. However, historically, homes appreciate at a rate that's slightly higher than the inflation rate. And that's key to know, because that means that not only is your home's value tracking with inflation, but it is actually increasing at a value higher than inflation, which is helping you to build that wealth, not just maintain with the standard cost of living, but actually to increase above that cost of living as well. And that's key when it comes to appreciation. So average inflation rate over the last 60 plus years, it's actually last 63 years, has been about 4.3%. That is key to know, because again, the average inflation, or what inflation currently has been over the last 12 months, is at about 3.4%. It did dip down to 3.1, but I think it increased slightly in the past few months if you go back 12 years from that, or 12 months from that rather. So that's something that's key to know. But appreciation helps you to invest in more real estate. So that's the point that I wanted to get to when it comes to appreciation, is that this is something that helps you to be able to build a rental portfolio to where you can use your first rental property as it appreciates, utilize it to help you purchase your next rental property. And this is how that works. So you buy a home, you buy that first rental property. Let's say you use a DSCR loan, or you maybe have enough money that you make to where you can qualify for wherever you're living and the next home. But whatever means you use to purchase that rental property, you've got your first investment property. That investment property is appreciating over time. So after 6 years, based on our average 63-year history of appreciation at 4.3%, after 6 years, you have over $100,000 of equity in that home. Now, what can you do with that? Well, there's a few things to access that equity. You can do a home equity line of credit. You can do a home equity loan. You can do a cash out refinance to access that equity out of the home, meaning you can keep that home, but now you have all of that money, that value that's in the home, because it's worth more than what you paid for it. And every month over that 6 years, you've been paying down on the balance. So that helps increase that equity as well. So you can use that, take that 100K, let's say, out of that home, and utilize that as a down payment via a DSCR loan to go and purchase another home. And that's how you build that rental portfolio, by using investment property equity. So you have that investment property over the next several years, that property is getting more and more valuable over time. And based on the 4.3% that we've had over the last 60 plus years, in 6 years, you've got over $100,000. Well, that $100,000 is a 20% down payment on a $500,000 home. Not saying you're going to go and get a $500,000 home for your next home. However, you just want to keep that in mind, that it doesn't take much to be able to, out of that equity, get enough to be able to purchase another investment property. And then it's wash, rinse, and repeat. Now you've got 2 investment properties that are appreciating. And as both of those investment properties appreciate, now you can withdraw equity, if you so choose, out of one or both of them to go and purchase 1 or 2 more properties. And so it becomes an exponential effect in terms of how you're able to grow your rental portfolio a lot more quickly once you get that first home and then get that second one, and it just keeps compounding from there. So let's do a little bit more math, because this is economics, real estate economics. So you purchase a home for $350,000. We've got our 4.3% yearly appreciation. Your home is going to double in value in 16 and a half years. That home that you purchased at $350,000 is going to be worth just over $700,000. That is huge, because in 16 and a half years from that point, it's going to double again, and you're going to have a home that's worth $1.4 million. So again, these are ways that we're talking about with your real estate as an investor being able to appreciate and grow you wealth. We're talking about generational wealth that is actually building you. So imagine if this is something that your parents taught you and that they implemented and passed on to you. And imagine if this is something that you teach to your kids, who turn around and teach it to their kids. We're talking about building generational wealth, where you have home after home after home that, after 30 years, these homes are paid off, unless of course you use them to purchase more investment property. But you either have a huge rental portfolio, or you have a smaller rental portfolio of homes that you own outright, free and clear, without mortgages on them. Either way, this is a great way for you to start building that wealth, and also instilling this, if you have children or desire to have some children in the future. This is a way that you can start building that wealth and instilling some of those values of investing in real estate over time. Because in my opinion, I believe real estate is one of the most stable investments and one of the best investments that you can have. So moving on from there, we'll talk about the stability of real estate. So principal and interest payments do not change. That is one of the things that really speaks to the stability of the real estate versus renting. I talked a lot more about that in my webinar last month. So if you want more of that comparison, you can listen to the one from January. But real estate, when it comes to owning real estate, principal and interest payments don't change. You have a 30-year fixed mortgage. That means for 30 years, your principal and interest payments are fixed. If you remember that slide that we showed earlier in the presentation, that's not the case when it comes to rent. Your rent is going to increase year over year over year. So as inflation goes up at its average rate of 3%, I know the Federal Reserve is trying to get it down to 2%, but even if it gets to 2%, your rent is still going to increase year over year over year, whereas your mortgage principal and interest payments are going to stay the same. And that's going to eventually get you to that inflection point where now you're going to pay more in rent than what you would have paid had you bought that home 4 years ago, 7 years ago, whatever it might be for whatever purchase price you got that home. That's where it starts working towards your benefit. So that's something you definitely want to keep in mind when it comes to the stability of real estate. Also, that 4.3% average appreciation that we keep harping on. Again, this is including the 2008 recession. And there haven't been many of those. I know a lot of people like to point to, oh, remember 2008, remember 2008, but no one can name a year prior to 2008 when we had another drop like that. 2008 was an anomaly. I'm not saying there hasn't been a drop in the market. I'm saying that those drops are very, very few and far between. And I have a slide later in the presentation that's going to illustrate that as well. So the average appreciation, including the little market dips that we do have, and the consistent increase in the value of the home over 60 years has averaged out to around 4%. And that's something that really speaks to you being able to grow wealth over time in real estate. Lastly, real estate doesn't go bankrupt. Reason I included this in there is because real estate is not the only means or mode of investment. You can also invest in the stock market. You can invest in a lot of different things. But when it comes to investing in businesses and companies via the stock market, there is that risk of those companies filing for bankruptcy or eventually going out of business. For example, I'll date myself a little bit. There was a company called Circuit City at one point that is no more. There is no more Circuit City. It doesn't exist. However, it's not the only company that used to be in existence and actually used to be a leader to build a lot of wealth for people in the stock market. But then, that story turned around and now it's no longer relevant. But Radio Shack also used to be a company that was a lot more, again, relevant and helped build a lot of people wealth. And now where are the Radio Shacks at? So again, it's something that you have a lot more volatility with when you're talking about investing in stocks and business. Now, I'm not against investing in stocks and business. I myself own stocks in the stock market. I'm a huge believer in investing in the stock market. Your returns on average are actually going to be higher in the stock market. The average return of the S&P 500 is about 10%. We're talking 4% for real estate, but it's about 10% for investing in the stock market. So your average return is actually higher in the stock market, but it's also more volatile and there's a lot more risk involved. Whereas again, speaking with the stability of real estate, the land is always going to be there. It's not getting destroyed. The real estate is not going bankrupt. Even if something happens to the house, there's homeowners insurance that can cover the cost of rebuilding that house completely. So again, it's not the same level of risk and there's a lot more stability when you're talking about investing in real estate that still appreciates over time, not as much as the stock market, but you still have that appreciation. So when you're talking about diversifying your investments, real estate is definitely a great place that you do want to be invested in. So this is the chart that I was referring to earlier when I'm talking about the history of the real estate industry. So this goes back to 1965, a little bit before 1965 actually, and it actually goes all the way to third quarter of 2023 for this chart. So as you can see, these are average sale prices of homes throughout this period of time. Starting in the 60s, you see that line just going up and to the right. It's a gradual increase. And then you notice when you get around 2008, you see that dip down. That was the recession that everybody likes to point to. Now, I want to pause right here to say The gray shaded areas that you see on this chart, those are all recessions. Those are recessions that happen throughout these different times. There was a recession in the early 1970s, mid 1970s. There was another recession in the 80s, 90s, early 2000s with the dot-com bubble, which was around 2002. And then obviously we have the big one that happened in 2008 with the Great Recession. So these are all recessions with the shaded areas. Now, I want you to notice how many of these recessions actually caused a dip in the housing market. You notice the big one from 2008, but you can't really point to any other ones that caused a huge dip in the housing market. And that's because of the stability of the housing market and the housing industry. It is a very stable investment where even through recessions, home values typically tend to remain steady or increase. You notice through some of these, the home values actually increase during the recession. You can't say the same for the stock market. When we go into a recession, if I were to show you a chart of the stock market, and I don't have one in this presentation, but if I were to show you a chart of the stock market, you would see a lot more of a roller coaster ride of volatility, because when that recession hits, the market goes down. People are pulling their money out of the stock market. And when, things are getting back to better, people are dumping their money back into the stock market. So you see a lot more of a bumpy ride, but real estate is a much more stable investment where even through recessions, home prices tend to hold steady. Again, there's the outlier of '08, which is completely different from a lot of these other recessions because it was actually a combination of the real estate and mortgage industries that caused this 2008 recession. So outside of that, you really don't see those drops in those recession times that we've had throughout the history. So that's key to pay attention to as well. So a bonus that I wanted to throw in there at the end, real estate can fund your retirement. When we're talking about retirement, and how real estate can fund your retirement, go back to that slide or you can think back to that slide where every 16 and a half years at a 4.3 appreciation rate, your home is doubling. And that's not just for a $350,000 home. That's for any priced home. If you had a $200,000 home, if you had a $500,000 home, at a 4.3% appreciation rate, your home is doubling about every 16 and a half years. And so 32 years, your home is doubled twice. That 350 has become 700, 700 has become 1.4 million. Now, in that 30 years, let's say that you don't continue pulling money out of it, but that you have paid it off because your average mortgage is a 30-year fixed rate mortgage. Let's say you paid it off in that 30 years. Maybe you paid it off sooner than that 30 years. You get ready to retire 20 years from now, 30 years from now, 40 years from now, depending upon what your age is. You're sitting on a home that's worth over $1 million. But not only that, it's cash flowing, because if this is an investment property that you are owning outright, that rent over the last 30 years has been increasing more and more and more and more. And that's what you want to keep in mind when I'm talking about funding your retirement, because 20, 30 years from now, you may very well have rental income to the amount of $8,000, $9,000 a month that's coming in 30 years from now on a house that you own outright. So if you wanted to sell that house and put your hands on $1.4 million or however much that home is worth at that time, you could do that. Or you could just live off the cash flow income that's coming in with that $8,000, $9,000 a month that you're getting from this single property. But if you have more than one investment property, you've got 2 properties or 3 properties, maybe you've pulled money out of this to purchase another one and pulled money out of that to purchase another one. So if you've got 2 or 3 of these investment properties that you've purchased over a, let's say, 10-year span, and then 20 or 30 years from that point, those properties are close to being paid off. You're cash flowing on all of them because the rent has continued to increase over those years. And now you're looking at retirement and you've got over $10,000 worth of residual income, or not residual income, rather cash flow income or passive income, as a lot of people like to say, coming in off of all of these rental properties, which can really help fund a lot with your retirement, especially in your later years where um, you might have care that you have to be able to provide, finances for, whether that be in-home care, nursing care, medical bills might start creeping up. Or maybe, you're in great health and you don't need any of that stuff, but you're able to go purchase a dream home that you want to live on, take routine vacations 3, 4 times a year, whatever it might be that you're wanting to do with those funds or with that money, you can do that now because you have laid a solid foundation in building up a portfolio of investments in real estate that are going to pay dividends in the long run. So that is all that I have for you this evening. Thank you for taking the time to tune in. Hopefully this has been great and beneficial for you. And yeah, I look forward to seeing you in the next webinar. We do these once a month, every month. So please do take the time to tune in. Take care. Be blessed.